Many people think stocks run the world. They don't. Bonds do. They have control over your mortgage, over credit cards, and over the economy as a whole. And in my quest to lose money professionally, I haven't given bonds near enough credit despite the global bond market being bigger than the global stock market. But a quick question before we get into it. Have you ever had any experience with bonds, or do you know anything about them? Let me know in the comments. I would love to hear. So what is a bond? It's literally just a loan, whether you give your money to the government, to a multi-billion-dollar company, or to some random startup. You give them money and act like a bank, and they promise to give you interest every year and give you your money back later. So for example, let's say you buy a 10-year Treasury bond at 5% interest with $1,000. The government will pay you $50 every single year, and at the end of the 10 years, they'll give you your $1,000 back. That's really it. At its core, bonds are pretty simple, but before I talk about the different types of bonds, let's explain why bonds exist, because why would anyone want to settle for 5% a year? Bonds exist for three major reasons. Governments use them, companies use them, and investors use them. Governments and companies constantly need huge amounts of cash for wars, infrastructure, expansion, payroll, and surviving during recessions. But raising taxes or selling stock is slow or dilutes ownership, so instead they borrow. And despite how much I hate Klarna and this whole buy now, pay later mentality, the world actually runs on borrowed money, and without bonds, recessions would be deeper, wars would be impossible to fund, and big projects would just take decades longer. And the reason you can't just use banks is because, well, one, banks can't just print $1 billion if that's how much you need, but also, it's a lot easier to get 100,000 people to give you $1,000 than it is to get one bank to give you 100 million. So that explains companies and governments, but why would investors want to invest in bonds? Well, believe it or not, it actually benefits both the retail losers like us and the multi-billionaires on Wall Street. For retail investors like us, you work hard and invest your entire life, and now you're ready to retire. You want some peace of mind, so you throw $1 million into risk-free U.S. Treasury bonds at 5%, and now you're getting $50,000 a year in cash flow, and you don't have to do a second of work. Now, it might not be the largest amount of money. Ideally, you have your three-legged stool set up, but regardless, your bills are getting paid without having to work risk-free. That's pretty much retirement for the most of us. But Wall Street can also benefit from this because bonds allow for a place to park massive sums of money. You can't put $500 billion into stocks without moving the market. You can in bonds. And on top of all of that, you're getting a pretty decent return. Real quick, before we get into the types of bonds, I cannot make a bond video without talking about the yield curve. It is used by many investors, large and small, and it's really not that complicated, but it is incredibly important. All a yield curve is a graph that shows different times of maturity compared to different bond yields. And normally, a higher time to maturity would equal a higher bond yield. This is because, one, you have your money locked away for longer, but two, you're giving more time for something to go wrong. And just to compare the 5-year versus the 30-year Treasury bond, it's a lot easier to say where we're going to be in the next 5 years. We have no idea what the hell is going to be going on in the next 30 years. But that's not always the case. Sometimes shorter maturity bonds have higher yields than the longer maturity ones, and that's called inversion. And a lot of people look at the 2-year versus the 10-year Treasury bond, but most investors look at the 3-month versus the 10-year US Treasury bond. And there's actually a graph, if I remember to put it on the screen. Every single time that we have had inversion and it has come back to normal since World War II, between 6 and 18 months after that, we have had a market crash, and it has been a damn good predictor of market crashes. A lot of people say that sometimes it'll happen for a couple days or a couple weeks, and that really isn't a good predictor. But on occasion, it'll happen for several months, and that is when a crash is coming. It has called the tech bubble, it called the 2008 financial crisis, it called COVID, it even called this whole tariff crash that happened recently. So again, it's really important, and this is why a lot of investors pay attention to it. So if you've never heard about it, consider looking into it. But now we can get into the different types of bonds, and then I'll talk about the secondary market, which is also massively important. There are 4 main types of bonds. There are government bonds like the US Treasury. There are corporate bonds, which are loans to companies like Apple and Google, etc. There are municipal bonds, which are basically loans to states and cities. And then there are junk bonds, which are risky, and they could be loans to a startup or a deeply indebted company. US Treasury bonds have some of the lowest yields in the bond market, but this is because they're considered completely risk-free. And if you've ever heard of the risk-free rate, this is what people are referring to. Now, these are going to usually be used by retirees that need safety and stability, but this is considered the benchmark. A lot of people will refer to the risk-free rate whenever they're considering an investment or a business endeavor. An example that I heard from someone is they were contemplating acquiring a new business to add on to theirs, but after doing the math, they realized that after all of the expenses and time and labor, he would only make about 10% return compared to a 5% risk-free rate, and he just wasn't willing to spend all of that just for an extra 5% gain. And another that you're probably familiar with is just any stock investment. The S&P 500 is the gold standard, not only because it is safe and diversified, but also because it has outperformed bonds pretty much every year except that one decade in like the 50s or whatever that was. But again, like I've said earlier, no one is going to settle for barely any return. Why would anyone put money into a stock or an index fund if it doesn't even average the risk-free rate? That is ridiculous. Moving over to municipal bonds from states and cities, these are still low risk but offer medium to low yield. But what's cool is these are often tax-free. So a 4% tax-free municipal bond might be the equivalent of a 6% taxable corporate bond. And since we're on the subject, let's talk about that. When I say corporate bond, I really mean investment grade bonds from big stable companies like I mentioned earlier. Now, whenever I first heard about corporate bonds, I was honestly scratching my head as to why you wouldn't just buy the stock. But cash flow is really all it is at the end of the day, and the yield is probably going to be a lot higher than the starting yield of whatever company you're buying. Of course, if you have a thesis for the bond value to rise on the secondary market, that's also a route as well. But a big risk with this compared to the government is companies can go bankrupt, whereas the government can just print more money. The last major bond type are junk bonds. These are for the Wall Street bets gamblers who have to make their least risky bet still risky. But the reason anyone would invest into a junk bond is because they offer the highest yields out of all the bonds. Now let's talk about the secondary market. I'd argue this is more important than the primary market that we just talked about, but this is what I'm referring to when I say the bond market is bigger than the stock market. And this is how bonds affect your credit card, your savings account, and your mortgage. People don't want to lock their money up for 20 to 30 years, so they trade bonds with each other. This is where a lot of the volatility and risk come in for bonds, because the bond market is actually more volatile than the stock market. But this is also where a lot of confusion comes in, because bond trading can happen for a myriad of reasons. The most important one being interest rate exposure. Now, generally speaking, bonds and interest rates have an inverse relationship. Whenever interest rates rise, bond values go down, and whenever interest rates fall, bond values go up. As a quick example of this, let's say you have a bond that pays 5%, and then all of a sudden interest rates are paying 10%. Now, why would anyone want to settle for 5%? Your bond is immediately less desirable, and of course, the value of it is going to drop, and the opposite is also true. So whenever someone buys or sells a bond, that could also be seen as I want more or less exposure to rising or falling rates. But since we're on the topic of bond yields, I wanted to throw this in here because I've been reading Beating the Street by Peter Lynch, and there was a time where his top holding was long-term Treasury bonds, and there's a little rule that he left us with. He says, whenever yields on long-term government bonds exceed the dividend yield of the S&P 500 by 6% or more, sell your stocks and buy bonds. I just thought that was a tidbit worth sharing because, well, we know Peter Lynch. Wise words from one of the greatest investors of all time. But that brings us to the second biggest reason that bonds get traded: credit risk. This is just the risk that your borrower will default and not be able to pay you, which is why the US Treasury bonds are considered risk-free, because they can just print more money if they need to. The main way that markets price credit risk is through credit spreads, which is the difference between a corporate bonds yield and a government risk-free bond yield. Wider credit spreads mean investors are worried about defaults, companies face higher costs of borrowing, and historically, widening spreads often come before recessions or financial stress. Whereas with narrowing or tightening credit spreads, investors are more comfortable taking on credit risk. Basically, wider credit spreads, investors are more fearful, and narrowing credit spreads, investors are more confident. But credit spreads are always changing, and they move because of several different factors. Some of the biggest being their actual ability to pay it back / their credit rating, which adds to the moat of credit rating agencies like S&P Global. But, it also moves because of market sentiment and interest rates, among other things. But just to sum that up really quickly, credit risk exists because companies can fail and miss payments. The market prices that risk through credit spreads, which fluctuate based on economic conditions, corporate health, and investor sentiment, and those spreads directly drive bond prices. Not every financial instrument is for everyone, but bond investors typically like to play it on the safe side, and because of this, we don't have to settle for measly returns. We can use the bond market as a tool for us with things like the yield curve and credit spreads like I've talked about. These are seen as leading economic indicators. And since we're on the subject, I'd like to leave y'all with another quote from Peter Lynch from his book that I've been reading. He gives an example from the Bank of New England, and he states their senior debt had fallen from par 100 to below $20, and that was a big attention getter for him. He says, if a company turns out to be solvent, its bonds will be worth 100 cents on the dollar. That makes sense. So when bonds sell for only 20 cents, the bond market is trying to tell us something. The bond market is dominated by conservative investors who keep rather close tabs on a company's ability to repay the principal. Since bonds come before stocks in the lineup of claimants on the company's assets, you can be sure that when bonds sell for next to nothing, the stock will be worth even less. And then he says, here's a tip from experience. Before you invest in a low price stock in a shaky company, look at what's been happening to the price of the bonds. So let me know if you learned anything. I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Good luck on your investing journey.